Today we're talking about investing risk, but we want to start the show by defining what investing is. Archie, what is investing?
Okay, so it's not trading. It involves compounding returns and it involves a long-term period of time because compounding returns require a long time to happen. So this eliminates Bitcoin, currency trading, share trading, flipping properties. None of these are investing. They're all trading. So we want to get back to what's investing? Compounding returns over a long time.
All right, with that settled, let's dive into today's discussion. Hey everyone, it's Lachlan Nicolson here. I'm joined by Archie, Franz, and Tim Evans. This is Mind Over Money. Hey guys.
G'day, Lachlan.
Hi everyone.
So today we're talking about risk. Specifically, what risk do we need to account for when it comes to investing? So we hear a lot of jargon, don't we, Archie, when it comes to risk and investing? What's some things that you hear?
This is high risk because it's a high growth portfolio, and that actually doesn't mean anything. People also say shares are high risk. Commonly hear that. I don't want to do shares, they're high risk. Well, again, what does that mean? What's yours, Lockie? You got one around gold there.
Yeah, I hear a lot, and also you see YouTube ads for this, that buying gold is a way to safely hedge against the markets when everything crashes, you know.
Right. What about all those gold bars under your bed, Lockie?
Oh, we won't talk about that.
But you gotta have the spruiking that there's going to be a crash because that's got to go,
right.
You know, to create the need for the gold. Yeah. The other thing I hear a lot is defensive assets like property or cash. You can't go wrong. You know, they're low risk. And honestly, I've just seen so many of them go wrong. So these are all assumptions and, you know, and jargon that we hear, and we don't even really know what we're saying or thinking because these are really poor rules of thumb.
That's a big thumbs down from us.
Oh, yeah, because rules of thumb, they're always got to be in context, and the context changes all the time.
Especially today, we're in an ever-changing world where something that could be true 10 years ago is certainly not true today.
And yeah, I guess there's also a lot of FOMO, and when risk is involved, there's a lot of emotions that just take over and really dictate how we make decisions, which is probably not the best way to make decisions. So yeah, I think it'll be good to take a look at risk from a more kind of data-driven or analytical view. So, and Archie, I've heard you talk about this before and I found it fascinating, but you kind of go through the different types of risks that there are out there?
Hang on, Tim. Is it data or data? Are we American or Australian?
I'm whatever I need to be. I'm just speaking to the audience. Data.
Let's look at the data.
Too many podcasts.
That's your South African coming out.
Or it could be because he's from Adelaide.
Oh yeah, of course.
Adelaide, Japan.
I apologize to everyone. My official apology.
Right, so first one we've got is bias risk. So these are all those things that we were just talking about before, the sayings, the rules of thumb. These are all our bias risks that we can have. And so we say, you can't go wrong with property. Property is the best way to go. Or people say, you know, shares, you can't go wrong with shares, the best way to go. So that's a bias risk. And it can come into, you know, how we think about investing. And we can totally forget that investing, like we said before, is all about compounding returns over long periods of time. And we can suddenly get pulled into doing all sorts of crazy stuff with a bias risk there.
A classic there is the anecdotal evidence that we can get from the barbecue, where a friend of ours that we heard of has done really well with flipping a certain property. And so we think that's going to work in our situation as well.
Yeah, definitely. One that you never really hear about is currency risk. So when we're investing, especially with our superannuations, we can actually have a lot of our super money invested overseas. And when our money's invested overseas, we've got this currency risk. So the Australian dollar is going to fluctuate, and the dollars of the other countries are going to fluctuate as well. So currency risk can see us lose 50% of our investment just with a change in currency, and we don't even know what's going on. And so in the past, we've seen super funds perform really badly because they didn't adjust for currency risk, or they didn't have any protection around currency risk. And so we've seen some super funds get really poor returns in the past because of that. The next one is leveraging risk. So this is where we're borrowing money to pay for things. So the classic is you do an investment property, you borrow a large amount of money. And so you're then carrying a large amount of risk because of that leverage that's going on there. The other place that leveraging risk comes in is when we're investing through index funds. Is that companies can be borrowing large amounts of money to expand their companies, which can put them into an index and make up quite a big percentage of an index. But what's not being managed is that leveraging risk. And so you're invested in companies that can be sitting on very large amounts of borrowings, which can suddenly send them over the edge. And therefore you get poor returns again. The next one is inflation risk. So this one is going to really impact our returns. So if we got inflation running at 3% and we've got our money sitting in the bank earning 2%, we're going backwards. There's no compounding returns because inflation is actually beating us. It's destroyed our return. So we need to get greater returns than what inflation is if we're going to beat that inflation risk. Next one is economic risk. So what do you guys reckon economic risk is?
Just the global markets, just as things change and go up and down.
Yep. Like Australia being in a recession, that affects our businesses. So and that's what when we're buying shares, especially when we're looking at superannuation money, we're buying shares in companies, and those companies are dependent on the economy of the country. So whether it's in Australia or overseas, what's happening in economies has a big impact on our investments and our returns. And again, if we're invested in something like a index fund, we have no control over what happens there. And the index will adjust according to what's happening with the companies. But we could be missing out on some really good returns because of that, because we're not able to adjust for what's happening in the economies in the world. The next one is liquidity risk. So I'm not sure if you guys would remember this, but back in the early 2000s, we had all these products being sold, especially through accountants and financial firms and stuff and banks, saying, that these products were going to earn these massive returns and they had all these tax advantages. But the one thing that no one was looking at was the liquidity risk. So that means that what happens if they get frozen? They suddenly get shut down, which can happen. And so that's a liquidity risk. And so people lost a massive amount of money because all those funds actually got frozen and died because of the global financial crisis in 2007, 2008. And again, people lost large amounts of money because of liquidity risk.
Right.
Okay, diversification risk. So with diversification, we got a big list down below, so we'll get to that one. Yeah, and then there's manager risk. So what do you think? What do you think manager risk could be, especially when we look at superannuation?
The human element involved.
Yep. Yeah.
Because there's people involved in these processes, and people have their own emotions as well, and they miss things, like you said, miss the liquidity risk. So I think that's obviously a part of it. Bit of bias in humanity.
Yep.
And typically one type of fund will have one manager, and then they're limited to what they can invest in based on their size of investments in the fund.
So if we think about some of our really big super funds in Australia, they've got massive amounts of money now. And so they're limited in what they can actually invest that money into because they need really big things to invest into. Yeah. And quite often, they're only offering just a few funds. So your money's just getting put into this one fund. However that manager performs depends on what you get out of it. So that's your manager risk. And we can spread that out by having more than one manager. and, get some diversification around that. And the last one is standard deviation. So standard deviation is how we measure the performance or the returns that are being achieved in a fund or on a portfolio on investments. And standard deviation it's a measurement of risk. If we just go out and buy an individual stock or share in a company and we know nothing about that company, the standard deviation on that particular company might be 20% or more. With a high standard deviation, that means that we could actually lose all our money. So the higher the standard deviation, the more risk that we're taking, the more chance we have of losing our money. But if we keep our standard deviation down around 10%, we know that we can't lose our money. So we can actually manage, that risk attached. Because I often get people say to me as a financial planner, they'll say, can I lose all my money? Like, I really feel like I could lose all my money. And you go, no, because the standard deviation is telling us you can't lose your money. Yes, it's going to fluctuate because that's what investments do. The capital does fluctuate, but you can't lose your money. So that's where the standard deviation comes in.
Yeah, so let's zero in on that diversification list because there's about 5 or 6 things in that list as well. Do you want to run us through that?
Yep. So the first one is asset allocation. So you've got different assets that you can be invested in. It could be property, infrastructure, Australian shares, international shares. We've got cash, fixed interest or bonds. So these are the different assets that you can be invested in. And so with diversification, you can spread across those different assets as long as you're taking into account the other risks that go with those different assets. So that's where you got to be looking at things like liquidity risk or, inflation risk, diversification risk. They all become quite important depending on what assets you're going into there. The next one is fund managers. So different fund managers operate differently. And so if we're looking at one super fund, and one of their particular funds that they operate, that they might have a matrix around how they invest that money, and that'll be different to another super fund. And so with fund managers, what's some of our super funds in Australia, they focus on buildings and property. Other super funds, focus on actually owning and properties and investments and stuff. So sometimes we actually don't even know what the fund managers are actually up to. So we need some diversification there. So we need to know, like, if we can actually have a selection of fund managers, and that removes this, fund manager bias that particular fund managers can have. Then there's the actual investing strategy. Is it an index strategy where we're just investing in indexes, or do we have an active strategy where we actually have a team of people actively managing what we're invested in and managing the risk of what you're invested in? So that can help create diversification as well. Then there's the industries and sectors. So there's all different industries. If we look at Australia is very strong in mining and financials. They make up a big part of Australia. And if we then go to another country, we can see, manufacturing as a big industry, depending on what country we go to and invest in. So there's different industries, different sectors to invest in. Then we've got regions. All the different regions have different factors that are affecting how they perform. Then there's time in the market. When it comes to diversification, the longer the term in the market, the better results we get. Because if we've got a nice diversified portfolio, that means some stuff's going to be slow to get returns and other stuff's going to be fast, and then it'll switch. So over time, we can get a nice balance happening there and more consistent returns over time. Yeah.
That's really interesting. Yeah, a big list. Could we get maybe a bit more maybe tangible on like, okay, let's say our popular different investment vehicles, like how does that help us? What does that look like? Like, let's say we invest in something like property or index funds, and how does the risk vehicle help manage that risk involved with those different investments?
So if you look at in index funds, they can help you overcome the risk involved with inflation. Also liquidity. They can have good risk management around liquidity, and also diversification. Because you're going into an index, you can have quite good diversification through an index there. When we compare that against, say, buying individual shares, you can potentially overcome inflation and also have, protection around liquidity. But doing individual shares, you don't have other protection mechanisms. You can have bias problems. You can have, what else we got there? Lack of diversification, so that's where it comes in. And the same with investment properties. Investment properties can be really good at overcoming inflation risk, and currency risk, because we're not investing overseas. We're probably investing here in Australia, so we don't have any currency risk. But then we run into all the other risks, because if we're buying an investment property or only buying one property, we've got lack of diversification. We've got leveraging risk and other risks that become involved, bias risk.
So all these different types of risks need to be considered and, I guess, managed in order to get a top quartile long-term return. So
what does a top quartile mean?
Lovely question, Tim. Like, we have a lot of data today. That's a good thing. We've got research, we've got data. And so when we're investing in particular areas, we can actually compare ourselves with the data in that particular area. So if we're investing through Australian shares, as an example, through a fund manager in Australian shares, well, we can look at the data around, well, what are all the different fund managers doing in that particular area? And, what's the range of returns that we're looking at? So the range of returns might be 0 to 10%. And most fund managers will probably land in the middle somewhere and getting an average return of, say, 6%. But then there'll be a percentage that'll be in the top quartile, and they'll be getting a return of between 8 and 10%. And then you got your bottom quartile where they're earning between 0 and 2%. So quartile just means the range of returns. And we want to be up in that top quartile. So if that range is up, 0 to 10%, we want to be in between 8 and 10%, want to be in that top quartile. That way we can measure ourselves against what's happening in the market, and we know whether we're achieving our results or not. And we can know what sort of risk that we're taking with that.
I love that, because you can't control everything happening in the world economy, especially everything's so connected these days. But what you can do is compare with data. How are we doing with the investment strategy based on the market around us, and actually compare apples to apples there, how your investment is tracking, and then zoom out to the big picture. In the long run, you're on a good path. So, Archie, how do we stop our emotions taking over when it comes to investing?
So we do need to focus on the data. We do need to know what we're investing in and what that data tells us about our investments and what risk we're taking. So we've got to get access to good data, which means we need a professional that can give us that data and actually knows what that data means. So if you think about, good data, what comes to mind for you guys, or what's not good data?
There's a couple of websites, I won't mention them, but they have investment data on them free of charge. And let's just say most of them are paid endorsements, less accurate data and quite biased. And I see a lot of people making decisions off that. Also just social media, people just spruiking stuff on social. Not great.
It's not good data. It's not proper research. It's, And look, I've actually seen in the past where, like I was saying before about back in the early 2000s, there was these products being sold that were supposed to be the best products ever, and they all failed. And, there was massive losses. But it had everyone was spruiking how great they were, but there was no data. And when I went hunting for the data to compare and find out how safe these things were and what was actually behind them, I was shocked by the lack of data, the lack of anything. And there was actually no real assets behind them. And I was just saying to people, whatever you do, don't invest in these things. And people were jumping in like crazy, and no one was listening. And I was like, oh well, it's like you'll find out in the end.
We see that today still with all the YouTube ads of these so-called professionals with their fake testimonials. It's just happening again and again.
I think a real professional will have nuance when they're talking and won't be pushing you down a path, I would say. Would that be a fair assumption? Because there's laws also around in Australia around professional to give professional advice.
They have to be licensed, qualified. There's a process, a methodology. Yeah.
Yeah. Yep. But you're also looking for the data. And so even though I work in a professional industry, there's still a lack of data at times. There's still a lack of proof of, that this is going to work. And the classic that I've seen in the past recently too has been the big push for self-managed super funds and buying property inside self-managed super funds. And our industry had a massive big push on that, which was very much linked to the property market and real estate agents. And, and people were buying properties in their super funds without looking at all the risks. So the data was really lacking. And now we're seeing people come out of that with no super. So we've seen those properties fail and we've seen people lose their super funds. We'll see the odd one turn up on TV, but these things are pretty common. So you want to see some data. That's the key part to it.
Okay.
Yep.
Show me the data or data. data.
So emotions, they are telling us how, whether we understand something, and and we all carry fear. So if we don't understand something, we can become very, what would you say, lack of confidence. We don't have confidence. And so we can be asking questions and, trying to figure out if something's going to work or not work. And that's okay because that's a normal part of a life is to actually have emotions. And so we can have fear, we can have, misunderstanding, or lack of understanding. And that's where you're trying to find a professional that can really help you through that. Because that, again, is what a professional does, is they'll help you through that whole situation. It's just like going to a surgeon, and they need to do an operation on you. You're looking for that confidence from that surgeon that they know what they're doing and that the operation is necessary. And it's going to work, and it's going to work. So it's the same with money. You're looking for that confidence. The other thing with emotions is beware of instant fixes. This is where we do get pulled into all sorts of schemes and scams and trading. And it's the promise, that something's going to be fixed really quickly, like we're feeling some pain. And it could be that, we want some money to put our kids through school, or we want, the car's dying and we need some money to fix the car or get another car. And so we've got these legitimate, needs. And we're feeling the pain of that, and we can suddenly be pulled into something because we're looking for an instant fix.
Yeah, it makes us vulnerable to good sales pitches.
Oh yeah, yeah. So that means we want to go back to our definition on investing. So what's our definition on investing?
Long-term compounding returns,
and it's not trading.
and it's not trading.
And Bitcoin.
And Bitcoin. All right, this is a good time to cut to a break.
Archie, I guess probably my personality is more of a saver than an investor. And I've come to realize that is not investing. And obviously with inflation risk that you're essentially going backwards. And I think there's a lot of people out there like me that love to save, but also want to do something and want to invest. And just probably thinking of the biggest fear for us savers out there is probably like the crash, that ominous crash that's just around the corner. That's always just around the corner. And then eventually it does come. But, what would you say to that kind of fear of that risk down the road?
Yeah. See, when we talk about crashes and we have this legitimate fear about a market crash or a crash in the finance industry, it's all about the short term. See, because our mind is on the short term. We're going, oh no, I've lost all that money. And because we're only looking at what's happening right now. Whereas when we look at it over the long term, the longer that we look at it over, the smaller that crash becomes. So if we look at the crash that we had back in 2020, that was a 30% reduction in the value of the markets. So it was quite a steep crash, very fast. It all happened in 3 months. And so that's when people are going, oh no, I've lost my money. That's our instant reaction. I've lost my money. And the thing with our portfolios came right back up again within 12 months. Within 12 months, we were back to where we were again. And so when we look long term, we go, oh yeah, that was a blip, it dropped and it came back up again. But then what we saw was this crazy peak straight after that. Like everything just peaked right out in like 22, 23. Everything's going crazy. And then we're going, that's going to definitely lead to another crash, another adjustment in the market. So then we see the market come back down again. So this is why we keep saying compounding returns over the long term is the only way to look at this stuff, because when you look at it over time, these are just blips. They go down, they go up, but there's a long-term return of 8, 9, 10% when we look at it over 10, 20 years. And that's a per annum return. And so we're beating inflation, we're getting our returns, and yes, we're going through all those market crashes and the market upsides as well. We're seeing those market upsides as well as the market downsides. But that's what gives us our return.
As you were talking, I just reminded that I won't say his name, but there is a very popular author who has predicted the market will crash many, many times. And you can look it up on Google. In 2016, he predicted the world would see the worst stock market crash in history. And he was dead wrong. Stocks around the world went to record high in 2016. And then, as we know, continued up till COVID. And then after COVID, continued to grow. And so I won't say who it is. I think we could probably figure out that if you do a quick Google. But just to say that there are always people out there saying that the next crash is around the corner. And it's just very not helpful information.
Yeah. Yep.
If every year you predict it, you'll be right eventually.
Yeah.
So the challenge is, to hang in there when others pull out. That's the challenge. It's to have a plan and stick to the plan. Because the plan will work, and that's where the emotions can really get us in trouble when we feel too emotional and we pull out of the plan, and that's when it's really hard to go back into it again. So I had one person back in the 2020 when the market went down who pulled their money out at the bottom and then managed to put it back in at the top. And managed to create pretty much a $30,000 loss out of $100,000.
Okay.
Yeah, and I warned them that what they were doing was very dangerous, and because you cannot time the markets. The thing is, you want that long-term return, especially when you look at super and you're putting money in regularly. Like, these market crashes are fantastic for us because we've got money going in there when the market's down, as well as when the market's up. So yeah, it all pans out.
That's a great point.
Yeah.
Okay, so let's wrap up this conversation. So I guess the big picture is we need good investing advice and support. We need access to good data. We need access to good products, not doing it ourselves, people to help us and give us the guideposts. to make great investing decisions. Of course, you should not do this yourself, and none of this is financial advice. You should not get your advice from a podcast. You should reach out to a professional, licensed, qualified advisor, such as our wealth partner at Waymaker is Right Track Planning. Archie, that is one of your businesses. So definitely reach out to a professional to get professional advice so that you can manage these types of risks and have a great return. That really investing is about creating long-term income. And so we want that income to be reliable and secure and stable. Otherwise, there's no point investing.
Yeah.
So
it's the only true
it's
passive
just gambling
income out there.
It is, yeah. And
yeah,
it's very accessible to us in Australia to do it.
Yes.
We're on a good wicket, if that's one thing I could emphasize. We're on a good wicket here in Australia and what we have available to us. Okay, guys.
Excellent.
Thanks everyone for listening, and catch you again in a fortnight.
Cool. Thanks, Lachlan. Thanks, Tim.
See ya.